I think what's been happening over recent weeks is potentially the start of a pretty important paradigm shift in markets. For the longest time now, really since the financial crisis began, the biggest concern has been around too little inflation, or in fact deflation. So central banks have been very, very focused on preventing the risk of deflation. And they've been doing that by keeping interest rates very low and through what's called quantitative easing, QE. I think during that period, we were in what I would call a good inflation paradigm. So that was an environment where inflation was seen as being a positive sign of economic growth. So whenever you got any signs of inflation, markets generally reacted positively to that because the basis was that, well, inflation has been too low for too long. That's what we're really worried about. Any sign of inflation shows that the economic environment is improving, things are strengthening, it's all looking good for the economy broadly. What the events of the past couple of weeks tell me is that we are now shifting into a bad inflation paradigm. A bad inflation paradigm is one in which markets become very concerned that there will be an overshoot of inflation. We'll actually get too much inflation, and that will force central banks to tighten monetary policy much more aggressively than markets are currently priced for. Our base case right now for markets and for inflation interest rates is that the US market is the furthest along this path of strengthening economic growth and inflation. We're seeing clear signs of inflationary pressures starting to build, but from a very low level. Particularly wages is one area where we see that coming. What's interesting was the recent sell-off in bond markets was triggered by the payroll release that came out, which showed the average hourly earnings were a lot higher than, the increase was a lot higher than what people had expected. But really, if you put that number into context, it wasn't an outrageous number. It was still within the realm of expectation. It's still a relatively modest number. So the fact that it triggered such an outsized reaction tells me that markets are very, very sensitive to this sort of change in dynamic, this paradigm shift from good inflation to bad inflation right now. What we had been noticing for a while, from as early as mid last year, was a lot of anecdotal evidence of wages increasing. So we were surprised late last year when we saw a number of US companies guiding for pretty substantial increases in labor costs for 2018. More recently, you've had Walmart give 22% wage increases to some of its lowest paid workers. You've had IG Metall, the largest trade union in Germany, win a 4% wage increase for its members. So these are all much higher than expected. And this is kind of anecdotal evidence that's not yet manifesting in the official economic statistics. Maybe we start to see that now. If we start to see that now, I think there's a real risk that this inflation panic continues and you see a very, very significant sell-off in bond yields.